Hello, friends. Good evening. I'm back with another topic, which is a very prominent one, and it is called dividend. This topic today we are discussing is from the student's point of view, is whether it is the management students, that is MBA students, or the BCom students, or anybody who wants to understand what is a dividend and how it is being calculated and how it is being distributed, what are the various types of the dividend. All these things we are going to study in this video. And I will take you through from the very basic level, from the layman's language, to understand the dividend part of it. So technically speaking, dividend is a payment made by a company, a corporation, to its shareholders. Usually, dividend will be calculated, it's a part of the profit. When a company earns a profit, it make it into two parts. One is that in order to meet the companies or the corporations expansion program and developmental program, it keep it some profit. Then another part would be declared as a dividend to the shareholders by the board of directors. The portion which the company retains for its growth expansion program is called the retained earnings, and the amount which is get distributed as a part of the profit to the shareholders, it is called the dividend. So now we must be clear that what is a dividend. So dividend is nothing but it's a portion of the profit which each shareholder would get it. So in India, dividend is taxable in the hands of the shareholders. The company has to deduct the tax and pay the net income to the shareholder. And in the individual assessment, the shareholder can claim this tax deducted at source, and accordingly he can file the return and pay the tax liability under section 140 capital A. Now let us try to understand that what are the various types of the dividend a company would declare. Normally the company would declare a dividend in cash, right? So it's not only the cash dividend which is being declared by the company, and there are practices of the stock dividend, property dividend, special dividend, scrip dividend, interim dividend, and final dividend. So the most prominent one in here is a cash dividend. Company usually, it's a common practice across that company pays the dividend in cash to their bank accounts, and it is transferred to the bank accounts after deducting the TDS. Apart from this, there are other types of dividends also the companies or the corporation would resort to, is like the stock dividend. When a company needs the money for its future expansion program, for its growth, then company can retain the full earnings, and instead of the cash dividends, the company can issue the stocks, that is the bonus shares. For example, every shareholder who's holding the 10 shares can get one bonus shares. For the time being, the shareholder who gets the share, a bonus share, will not get anything except the share. But later on in the next year, instead of claiming the dividend on 10 shares, he can claim 11 shares. So it's a future growth options for him. So that is one of the options apart from the cash. There could be possibility that the company can declare the dividend in the form of the property also. Other than the cash and the stock, that is a bonus issue, the company can give it its assets as a dividend to the shareholders. That is also a possibility. Then scrip dividend. Scrip dividend is a promise. Scrip dividend is a promise given by issued by the company in writing that we will be giving you the dividend in future days or the future months. So it's a kind of negotiable instrument act in Negotiable Instrument Act 1881 that can be negotiated, can be bought and sold into the open market. Apart from this, we have a few more types of the dividends, like interim dividend. Interim dividend is a dividend which is declared by the board of the directors as per section 96, as per the declared by the board in between two annual general meetings. So as per section 96 of the Companies Act 2013, every company other than a one-man company has to have convened the annual general meeting once in a year. So in that annual general meeting, the company can declare the dividend, and in between two annual general meetings, whatever the dividend it is declared, that is called the interim dividend, and once for a year, whatever the dividend it is declared, it is called the final dividend. So the difference between the final dividend and interim dividend here, if the company declares revenue once for a year in the annual general meeting, that is called the final dividend. For example, company earns rupees 1 lakh as declaring 1 lakh as a dividend, and even after declaring the final dividend, the company after 6 months it declare again the dividend of 5%. So that is called the interim dividend. The dividend which is being declared in between two annual general meetings is called the interim dividend. So now you know that what is a dividend, what are the various types of the dividend, right? But do you know that what the various factors decide this dividend? Dividend is a concept which is not haphazardly or intuitively decide that, okay, fine, I'm declaring the dividend of 10%. But based on what? One should understand that based on what the dividend is being declared. Declaration of the dividend is depend on so many factors. Number one could be profitability. The company which is earning a huge profit can declare a huge dividend. A company which is earning less profit would obviously declare the less dividend. If there is no earnings, no dividend at all. At the same time, one should understand that there is another factor which affects this, is the liquidity. Liquidity means a company can earn the profit, but it is not necessary that all the profit should be in the cash box. All the profit should be in the bank. No, it is not necessary. Liquidity and profitability are two different concepts. You can earn the huge profit, but still you might not have the money to declare the dividend. So a company does not have enough cash to declare the dividends. So they are running out of this one. That is the liquidity part of it. So profit is not equal to cash. Let us understand this concept. Profit is never be equal to cash. So there could be possibility that you have sold the goods on credit and you have not realized the money at all. And if you have not realized that money, then obviously there is no liquid cash with you, right? And you have given 3 months credit. You will get the money only after the 3 months. Then you will come to know how much cash you have at your disposal to declare the dividend at that point of time. So basically I wanted to tell you that profit is not equal to cash at the bank. That is the concept which we understood now. So other concepts are that apart from the liquidity, profitability, the seasonality. If any company belongs to the industry where they are working on the seasonality basis, that means they have to buy the raw material and keep it more. The working capital is increasing, the inventory is increasing. Then they need more and more working capital. If you need more and more working capital, obviously you will declare the less dividend part of it. It affects it. Whether you declared more or less, but this factor should be considered and given the importance. And stability of the earnings. Another factor is the stability of the earnings. If you are stable earning across, then the company can predict that how much amount they have and how much amount they are going to declare as a dividend. One more factor which would applicable to this declaration of the dividend is your debt obligation. You have taken the loan from the bank or you have issued the debentures. Every year you earn the profit or not, you have to pay the interest. Your debt obligation is more, your outflow of the cash is more. Once the outflow of the cash is more, then you will have less amount at your disposal to declare the dividend. Taxation policy. This is also one of the important factors, right? So dividend actually is in India, as per the Income Tax Act, dividend is taxable in the hands of the shareholders. The company deducts the TDS before declaring the dividend and only pay the net amount. In the individual assessment, while filing the return under section 139 or whatever it is, response to the notice, 142 or whatever it is, you will adjust the tax liability and pay the remaining tax, ultimate tax liability. There are legal restrictions as well. Legal restrictions in the sense, you have to declare as per the SEBI and the Companies Act 2013, you have to declare the dividend only out of the current year's profit or accumulated profit. You cannot declare the dividend out of the capitals. And before declaring the dividend, one has to transfer certain amount to general reserve. Then only you can declare the dividend. All these restrictions or the legal restrictions, or we can call it the legal constraints, are really important to understand it. Then at the same time, shareholders' expectations also. If across the years you have declared a dividend of 10% and now it is not wise to the company to declare a 5% dividend, because the good name, the goodwill, the expectations of the shareholders will shatter. So what you have to do, you have to declare the dividend stably every time. And at the same time, one has to look into that how much inflation rate, how much is the interest rate which is going on. You are declaring the dividend at 5%, but the inflation is going on at 7%. Is it a wise thing? Why should a shareholder invest in a company where inflation is more than whatever they are getting the income by way of the dividend? So one has to take, the finance manager has to take into account, the board of directors have to take into account all these things into consideration before declaring the dividend. In the further episodes, we will learn that what is the various amount of what is the various amount you need to transfer to general reserve, how much is the taxation, what are the other factors which are affecting the dividends. Please keep watching my channel. Thank you so much.